We haven't heard this recently, but certainly over the past several decades, one of the common comments among investors and our clients was, I really want my portfolio to look like Harvard or Yale
Sure.
because they just consistently beat the market and they don't seem to ever take any losses.
Right.
Well, my name's Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
So, one of the secrets to having portfolios that never take losses is being able to establish your own price for the asset.
Now, that's a handy thing right there. Yeah.
So, when we go back and look at some of these portfolios and the big endowments at the major East Coast, well, mostly East Coast elite universities,
Sure.
what we find is that they had shied away from the stock market, not quite so much the bond market, because they needed consistent income to deal with pension administration issues, regular ongoing cash flow needs. So what did they do? They bought alternative assets, which were promoted to them by Wall Street in private format. Now, some of them may have been direct ownership. So they bought agricultural land, which became an operating property in many cases and has some tax implications associated with it. They bought timber. Well, the average family doesn't go out and buy 5,000 acres of timberland and put it in their IRA.
This is true.
It doesn't happen. And even though there are now some exchange traded funds that do own timber companies, it's not quite the same thing. The other portion to stabilize bond market volatility was to do private equity, buying companies or portfolios of bonds in a non-public format. Well, what happens when that is in your portfolio? Well, there's no public market. Every quarter, the analyst or the pension consultant has to come up with a valuation for the trustees. So they go to the sponsor of the private equity and say, tell me what this is worth. And the guy goes to the commodities market and says, well, lumber's trading higher a bit. It was down, but let's, with what we own good quality stands of timber. So our estimate is X. And that's what goes on the rate of return report for the quarter.
No, it's really critical to understand what Don just went through there. That explanation is exactly what goes on, and because it's as titled private equity, they're not multiple buyers that are saying here's what I'm willing to pay, and that's how the price gets set. It really is set like the good old fashioned one martini, two martini, or three martini appraisal that you're getting on some private land that you need to sell. It's, well, let's just get together and hash this out and decide what this is worth today. And so that's a very, very different process than saying I'm going to buy even real estate or in any stock or bond portfolio where you can look at what publicly those shares are transferring at all the time, every day, and get a really, really good price instead of, well, nobody's going to buy this or sell this but us, so we get to say what it's worth. And that really is how it goes on.
Well, and part of the complication is that many of these properties are acquired with leverage. So you're borrowing money to buy them. And it may be a portfolio of commercial or apartment buildings, and they're highly leveraged. There's no ready market for them. And intentionally, they're not planning on selling these things right away. They are as pools of money for the endowment of the university. They're long-term commitments. And that's fine as long as they don't need the money. As long as the government keeps pumping money into their university, they don't need the endowment. until, of course, the money flow quits coming. And then all of a sudden it's, we could use some extra cash here. Let's sell one of these. And the consultant has to say, well, now, let me contact the sponsor and see what we can do. Because you do remember that there are limitations on how much and how frequently you can make withdrawal requests. And it's a request, it's not an order. So we have to find out if they can liquidate, if they have cash, and if they will. Now, if you're the sponsor and you get that request from Harvard or Yale or whoever, and
Right.
you say, well, I don't want to make the trustees mad, and I don't have enough cash, and it's pretty close to what they would expect us to give them, we'll borrow some money and we'll take care of their cash request right now, and we'll start working on how to build up the cash reserve that we need and pay off the loan.
We got to wind this thing, right?
Well, that's been going on for some time, and they're not coming up with a lot of answers, because for the last, I'm going to say, close to 40 years, Wall Street and the pension consultants have been selling private equity to these big endowment and pension funds. They have run out of buyers, and the pension funds want money. They want real money that they can use to make pension payments. Who'd have thunk it? They need money to make pension payments.
That's what we're here for. And eventually, like I said, Don, the lockup provisions of a lot of the private equity will say, well, you can't even look at this money for at least 10 years. And then we'll start to talk about, maybe we'll look at some of it, maybe we won't. And if you're a pension plan, your job is to pay out pensions. And the more you get locked up in private equity, the less cash flow you have to run your fund. And at some point you max it out. And like you said, all of a sudden they're like, wow, we can't take on any more private equity because we can't have our entire balance untouchable to us for the next 2 decades. That's not reasonable for us to do. And then, like you said, if you get another cash flow issue and all of a sudden you're not getting government support like you were, well, okay, now our requirements are going to change. Yeah, but you've got a lot of private equity on the books, and that's going to take literally decades to unwind. And all of a sudden you're in a little bit of trouble. So you begin to look around for, well, what are we going to do here then?
And there's an easy answer, and that is find another buyer. And where's that buyer? It's called the retail marketplace.
Bingo.
2 areas. We get emails from exchange trade fund sponsors on an increasing basis saying, look at this, you can replicate Harvard and Yale for your individual clients by investing in this private equity concentrated exchange traded fund. You have liquidity because the ETF is liquid, but the assets underneath it, let's not talk about those.
Yeah, don't go there. Yeah.
The other area is to go to 401k plans and get the SEC to authorize private equity acquisition by major 401k plans.
Yep.
But that's all we're doing is passing the problem and giving profits to the major institutions, passing the liquidity problem to retail investors. If your financial advisor says, we should talk about private equity investments to balance out the risk profile in your portfolio, beware. Probably pack up and run the other way and go find another advisor, because there's no real way that a non-liquid investment put together with some other non-liquid investments inside an exchange-traded fund or a mutual fund reduces the risk or creates liquidity for something that is not liquid.
But when you said that, Don, it was like, you know what? This sounds exactly like the subprime mortgage crisis.
Exactly.
Like, let's take all these bad mortgages and put them together, and then they'll become good mortgages because there's a whole big group of them. It's like, no, now it's just a big group of bad mortgages. And it's like, well, here we have a real huge group of illiquid, non-marketable securities. well, let's put them all together and sell them to a lot of people, and then they'll be liquid. It's like, no, they won't, which is why the fees attached to them are going to be significant, which is why Wall Street's coming after you to try to sell those. It's like, look at all these people that don't have this. And we are going to make sure that we, quote, educate the investors out there that, well, you're missing out. You have never had the opportunity to buy these. You've been kept out of this market. Well, by gumbo, we're going to let you in. And you should you should look at that very, very closely and make a decision based on whether or not that really makes any sense for you. And don't get caught up in the hype, because there's going to be very little talk about, well, exactly how risky is this, and exactly how long is this lockup, and is this really a big deal? Well, no, we're just going to put a little of your portfolio in there. It's really not going to matter. Don't worry about it, unless you need the money, for some other reason, like life happens, so you need to really pay attention, because the pitch is coming. Wall Street's going to be pitching these. There's hundreds of thousands of new investors that do not have this, and we're going to make sure they can. We're going to sell it to them.
You mentioned the subprime mortgage problem, which was exactly what I just described is going on in
Yep.
private equity. As
Yep.
far as we can tell, of the solicitations we're getting to use these in client accounts, which we are not doing.
Correct.
There's a prior similar situation, which we go back into the 70s. So most of the people on our podcast probably weren't in the market in the 70s. But at that time, it was letter stock. And so coming out of the 69, 70 bear market, companies wanted to raise money. They would do private placements of their stock offering. And Jerry Tsai had, I want to say it was the Enterprise Fund, but that may be the wrong name. But he had a mutual fund, and it was having phenomenal returns in the early 70s, but 73, 74, as the market recovered before the next bear market occurred.
Right.
He had a winning track record, and people were piling into his funds. And when the next bear market started back in the mid 70s, they wanted out. Well, letter stock didn't have marketability. It was tied up for a significant period of time. And he had his track record by making his own evaluation of what the letter stock would be worth if it was tradable based on what was actually trading, except that there's nobody there to buy it. And there's the risk with what I see developing in this private equity for the retail investor community. Is the problem that's going to happen in the next bear market, and we don't know when that's going to be.
Isn't that the truth? Yeah.
Or, as you just said, life happens, and the next time you are running out of assets to sell and you have to sell yours, you could get caught in one of these liquidity crunches because there's no cash there.
Yep.
Or you and a bunch of others make requests at the same time, and the fund doesn't have the ability to generate cash. That's where the problem lies. It is an opportunity for Wall Street to transfer profits, cash profits from retail to the big pension plans and the big endowments. It's taking care of their favorite customers at the expense of Main Street. So
it is, and they will bury that information best they can when they're presenting this as an amazing market opportunity for all you poor investors who've never had a chance to do this. So go in with your eyes wide open. Ask the questions that you know you need to be asked, and don't just get sold something here, because it's not going to work out well for you, potentially. So there's more risk involved than will probably be represented accurately, and it's going to be up to you to hold the line on. Nope, that's not for me.
And you just mentioned risk, so it may not be presented as an opportunity to enhance returns, but as a risk diversifier. You're not happy with the volatility in the stock market that moves a lot. Here's a way to stabilize the portfolio value as a risk diversifier, which is the way in many cases it was sold to the pension plans. So buyer beware applies in this case with a private equity offering coming your way. If you like what we've covered, subscribe. The link is right down below there. Subscribe to our podcast. Stay in tune. If you've got questions about your own stuff or something that has been pushed your way and you want to talk about it, give us a call. Send us an email. We'll be glad to spend some time with you. Have a great day, and thanks for being here today.